Hey everybody, this is Micah, aka Deadly Laugh, and a lot of people have been asking me either to trade for them or how do I do my stock trading, stock options trading. And so I figured I'd make this video to help everybody out. First off, I don't trade stocks, I trade stock options. It's a clear distinction. If you want to know what an option is, there's plenty of great articles and videos out there. I'm not going to bore you off the details, but this is just how I do it. So I use TD Ameritrade. I really like their Thinkorswim platform. Mobile is especially good. So just going to start off with how do you find the stocks you want to trade? So you come under Scan, Stock Hacker, Add Filter, and you want to have 2 stock filters and 2 option filters. Just click here, easy. Set up last volume, days to expiration, and implied volatility. The last is just what's the last price of stocks traded at, and I put a minimum of $50 because where my account's at, if I go below, I have to put a lot. I have to do a lot of contracts, and I really don't want to do that if I can help it. Volume 500,000 is a minimum. I just want a lot of people trading the stock, so I know I can get in and out as need be. Days to expiration, I put a max of 60 just to make sure I'm targeting those stocks who have options within the next 2 months, so I can trade them. The implied volatility 70% minimum, because the market bakes in extra value for the volatility, and the market's almost always wrong when it comes to what they think, aka implied volatility, to what the actual volatility, aka historical volatility, is. And so then I save this scan, and I save it as money. A good thing about TD Ameritrade is that turns into a watch list. So on your little dock down here, you can select which watch list under personal, and if you tag it as a whatever symbol, do your quick chart symbol, and then you do your trade and your charts up here. I'll show you as symbols. It links everything, so you can just go clicking down your list, and just makes it a lot faster and easier to trade. So that will pull up a list of stocks to choose from. I'll choose one, and I'll go to chart. So let's just look at Google. So this is what I was talking about. Historical volatility is almost always lower than what this cyan blue line implied volatility is. So right now it's at 0.35 implied versus 0.28. That's good. We want this number implied to be higher than historical. That means there's extra money. It's like selling a wallet for 20 bucks when really it's probably worth 10. You have an extra $10 baked in there. So when that price comes down, you could just maybe buy that wallet back from somebody. Car dealerships do it all the time. They sell you a car at a certain value, they buy it back at a lower value. Usually they're buying a used car and then they're selling it for a higher value. You're just baking in value there to make money. RSI, just a simple little study. All these, by the way, you add from the studies tool. Just look them up. If it's above 70, it's been overbought, which means recently a lot of people have been buying it. It's below 30, it's oversold. Recently, a lot of people have been selling it. So let's zoom in a little bit. So you can tell Google, a lot of people have been buying it this week. So the RSI's up. MACD is just a convergence of trend lines of, okay, well, what's the overall trend? Is it heading up? Is it heading down? That kind of thing. And so right now what this tells you for Google is it's high volatility. It's a little overbought, and that's what these two right here confirm for me. So if I go to trade, I'll pull in. These are some trades I was looking at earlier. Let me just clear them out real quick. And by the way, I only do vertical options, and I'll show you why in a second. So in here, I only look at the months. I don't look at these weeklies. The months have more money baked into them, and I make sure my layout shows probability of in the money and open interest. You can just click on it, go to customize, and set it up. And so what I look for is I always look at the 30% or so of probability that by February 19th, this strike price of 1980, the actual price of the stock is going to be higher. And so this is what I do. right click, I sell a vertical, because like over 80% of stock options expire worthless. So we want to sell them. It's like insurance, selling you, because how often does insurance pay out big? Very rarely. Or a casino, how often does a casino pay out? Very rarely. That's what we're basically becoming here. So for one contract, that's 100 shares of Google, which almost has a $2 million valuation. I'm going to get paid $450 to control that. What I do is I immediately, and this is much easier on the phone, I'll sell a vertical spread, and then I will set it up to trigger the buyback. So I may sell at 450, but I'll set it up to buy back at half that. And I'll change the TIF, which is time enforced, on the buyback good till cancel, because for the day, I only want in that trade that day because all my parameters, my rules are set up. If the day passes, I don't want it to trigger the next day because things could change. Maybe they do, maybe they don't. But then once I'm in the trade, I want to get out at 50% of what I sold into. And this works for both puts and strikes. I'm not going to go into the difference between calls and puts. I'm not going to go into the difference between those two. Like I said, there's a lot of good information out there. I don't really pay attention to any of the Greeks that they talk about for options. This is just how I do it. Come in, I look at the watch list, I check the chart, I'll check the news, see if there's anything telling me why the stock's moving, then I'll come and check the options. So, the 30%, what I'll do is I'll look at this spread. The spread means the difference between the strike prices. So that's $10. I'll multiply that by the probability that I have to pay out, which is why I use probability in the money. That's the probability I will have to pay out. So on a $10 spread, probability of 31.27% gives me $3.13. Well, we can see right here that I'm already over that at 450. My minimum would be $3.13 to get into this trade. And so if I'm good with that, which I would be, I'd click confirm and send. So this tells me my max profit, my max loss, and then how much money I need to have in my account to put this trade into effect, and the different costs it will be. But just to show you why I only do verticals, so here's selling the vertical. The stock's right here, and these are percentage points, so just probability points. So let me just move these all to one spot. So my probability of getting the max value is actually almost 82%. The probability of being of losing money is 16.75%. Because this blue line is what is the risk reward chart at expiration, so the 19th of February for this contract. So as you can see in the bottom left down here, my max is 450. I gain, my loss is 550. And so I'm fine. Like, people are like, well, you're capping how much you can make. Yeah, but I'm also capping how much I can lose. I don't care about how much I can make. I care about how much I'm risking. And because I'm only really shooting for 220, let's do the calculator real quick. 220 divided by 550. That's still a 40% return. That's what I'm shooting for. On a probability of 80%, I'll take that. Every time I'll take that. It's like hitting a bunch of singles. You hit enough singles, you're going to have more runs in baseball than your opponent that is going for home runs all the time. It's just a fact. Look up Babe Ruth's slugging percentage. He struck out more times than he hit home runs. Or how good really was he? I'd rather have Ichiro on my team. 9 Ichiros would beat 9 Babe Ruths or 9 Hank Aaron's. Because Ichiro's going to get on the base more often than they are. And that's what I'm doing here for the stocks. And so then I just want to make sure I buy back at half of this. So I just always hitting those singles, slowly adding up. Because the few times that I lose, which I'm only losing like 10, 15% of the time, I'm winning so big it makes up for it. My monthly returns are averaging 15% a month. And this is all I'll do. I'll go through it one more time, real quick and easy. Because I do it twice a day, usually about 30 minutes after the market opens. So for Central Time, that's 9 o'clock in the morning, and then 30 minutes before the market close, which is 2:30 p.m. Central Time. I'll just come in, I'll check to see if there's anything big's happening for the trades I'm currently in, and then I'll look for, if I have this the money, I'll get into something new, and I'll get into the, how I decide how much I do on each trade in a second. But just to recap, I scan, I have this saved as a watch list. I pick, because it's the weekend when I'm filming this and it's not going to show, but I pick out, something, let's say Google. I look at the chart. I look at the historical and implied volatility. If implied volatility is higher than historical, which it should be based on our search criteria, I'm pretty excited. I want that. Then I look at RSI. If it's high and there's no news, like right now, Google's really not popping up for anything. Just, emotions of what could come. There's no reason for it to pop up. So, I'm probably going to come up here and do a call, which means I want it to stay the same or go down. MACD is showing it going up, but it's not really going up a whole lot. It's just kind of, starting to flatten out, which means a correction could be coming soon. And I only trade maximum of 70 days out. So right now I'm only looking at the February, which is 27 days away, and the March contracts, 55 days away. March contracts, we can come in here if I want to do a call. Find the 30% or close to it. Let's sell that. Get rid of these other ones. And then I'm going to immediately buy it back. So, $100 spread here at $31.95. But, that's where I would want. I wouldn't do the March because it's only giving me $25 for that spread. I don't like it. I'll go back and do the February ones because they're much more in line with what I want to trade. So let's delete these. I don't know why it keeps popping down. But, 450 is greater than 3.127. So I'll take that all day. And I'm only going to be in that trade for 27 days max. I'm probably be out of it before then. And I'm totally fine risking $550 for 220. Like, give me that all day with that high percentage. So now figuring out how do I choose how much to put in and how much of my overall account. Because this will work no matter how much you have, what percentage account or what size account you have. It's all percentages, so it doesn't matter. So let's just start with a relatively small account. So $1,000. Well, I'm at max. I'm risking 3% per trade, so that's $30. So I may have to go into the scan and lower it down to $5 stocks. $5, $10 stocks to get something that I can do $30 on. But also with $1,000, I'm only going to keep doing contracts until I've put a total of 800 in. So 800 divided by 30 means I'm only doing about 25 to 28 contracts a month. You get that? So 800 is the maximum of the one. If my account's $1,000, 800 is the maximum I want to be trading at any time. And of that 800, I only want $30 per trade. That way, if a trade blows up, I'm only out $30 out of 1,000. I'm only out 3% of my money. So now let's make it bigger. 100,000. Oh, my mistake. 3% of 100,000 is $3,000, and these trades aren't come out right at this percentage. Obviously gonna be around there a little bit. So 80,000 is 80% of 1,000 or 100,000 divided by $3,000. Still comes out 25 to 28 trades to get my target. And if I'm winning 85% of the time at 40%, or that's a pretty high one here, but at 20 to 40%, those few percentages that I lose, they get washed away. So I'm still net, And so, like I said, it takes me very little time every day and every week, and really makes a big difference. But that is it. If you got any questions, let me know. I would be glad to assist any way I can. Hope y'all have a fantastic day. See ya.